The combination of these four things kills my ability to deliver rents to that middle class America. And so I'm not suggesting that the Fed is going to cut rates anytime soon, but what I'm pointing out is that if you look at the mentions of the word deflation or disinflation in the last 30 days, the mentions are up over 400% because unemployment is very low. So they have no incentive to cut fast. Obviously, if you bought in 2020 and you got lucky because prices went up in 2021, that's fine. But that had nothing to do with fundamentals. And you're asking a fundamentals question. That simply had to do with the fact that we rained $2 trillion on our economy and everyone bought stuff, right? Nothing to do with fundamentals.
Hey everyone, welcome to another episode on Wealth Strategy Secrets. Today we're joined by Neal Bawa. Neal is a technologist who is universally known in the real estate circles as the mad scientist of multifamily. Besides being one of the most in-demand speakers in commercial real estate, Neal is a data guru, a process freak, and an outsourcing expert. Neal treats his billion-dollar portfolio as an ongoing experiment in efficiency and optimization. Neal serves as the CEO and founder at Grow Capitus, an iconic data-driven commercial real estate investment company. Grow Capitus' 28-person team acquires and builds multifamily and commercial properties across the U.S. with more than 800 active investors and over 2,000 reviewing projects. The Grow Capitus portfolio currently spans across 10 states with 31 projects and completed equity raises of $270 million for multifamily while on track to close another 1,500 units in 12 months. Neal, welcome to the show.
Thanks for having me on the show, Dave. It's a delight to talk with you again.
Yeah, absolutely, Neal. Always enjoy our conversations and really looking forward to, sharing some of these pearls of wisdom with the audience today. So for folks who don't know you and haven't heard about the mad scientist coming from the tech space, tell us a little bit about your journey and how you got into real estate and alternative investing.
Sure. I am a computer science graduate, so software engineer that is focused in data science. So I'm a data scientist. I've had a successful tech career, 14 years. I've had a successful tech exit, class leading multiples. And I was doing, while I was, running that company, we had 400 people reporting to me. I was using real estate as a way to get my taxes down because I live in California. And so there were years where I paid 53% of my gross income as taxes, and real estate was the way to get it down. And ironically, unlike most people that get into real estate by doing a fix and flip or buying a single family rental, my first experience with real estate was in 2003 when my boss, the senior partner in the tech business, asked for my help to build an entire campus from scratch. We didn't want to be renters anymore. We wanted to have our own campus, no investor money. It was just our money, all cash, no loans. We built a first campus, and I learned so much from that, that development process, that we ended up working on 6 other campuses over the next 5 or 6 years before in 2008 I started doing aggressive data science on real estate, realized it was the best time ever to buy, and ended up basically buying a property every month for a significant amount of time.
Very interesting. So on this show, Neal, we talk a lot about wealth strategy, right? Because as you know, investing in real estate and alternative assets, it's completely going against the grain or the other, 95%. So as you went through this journey yourself, did you develop a particular investment thesis, or have you created kind of your own wealth strategy in terms of building your wealth that you've been following?
Yeah, I did. And it sort of developed organically over an extremely long period of time. So in 2008, 2009, I started to mine, websites like Zillow and the Department of Labor Statistics using a Ukrainian hacker and gather that information and put it into a software that we use as data scientists. It's called R. The software's name is just R. And so we put stuff in there. And what we do is we take massive amounts of data, we stick it in there, and what we try to figure out is there a correlation between X thing and profit? Is there a correlation between population growth, job growth, income growth, crime, and profit? And how can I parse this by city? Can I parse it by state? Right? What shows me that which of these things is a bigger indicator? Which one leads to more profit? Right? And what is the combination of these factors that leads to the highest amount of profit? And then we back test it over the last 10 years so that we're not just making stuff up. We're basically testing it against what's happened in the past. So when I did that, I I realized that there were five factors that had a very significant impact when you were buying properties, and then there were some additional ones when you were building them. And so I started in my business, in my technology business, we had large classrooms, and so I opened a meetup group. And initially, the meetup group was more about multifamily, and I really enjoyed that process. But then I was like, I'm a geek, I'm a nerd. Where are all the other geeks and nerds out there? Don't they want to know about this methodology that I have? So I also created a meetup group where I started presenting my findings and my investment thesis. And somebody came in and said, you need to give it a better name than what you have, because I had some statistical analysis, blah 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 blah, horrible name. And they're like, no, no, give it a better name. So I said, what's a good name? And he said, location magic, because what you're really talking about is what are the specific things that create the best location for real estate profits. I'm like, I like that. So I called it Location Magic, and I opened a meetup about it. And the first time, Dave, four people showed up, but three of them were from Apple. So they were all making good money because guess what? They were data scientists. So they were really attracted by this meetup. And then next time I taught, there were 10 people. And a year later, there were 100 nerdy, geeky data scientists, software programmers that were coming in, and everyone's contributing and everyone's doing stuff, and we're putting this stuff on the web. There's no LPGP, there's no deals. It's just all people sharing data together, and everyone's doing their own thing with it, right? And this is 2009, 10, 11. And then somebody comes in and says, this is amazing stuff. But you got to dumb it down for the people that are not, software programmers or data scientists. So I started to work on that, and I spent 6 months basically dumbing it down to where anyone can take like a 1 hour course from us, 1 hour meetup, and then in 10 minutes they can figure out whether Columbus, Ohio is a better city to invest in than let's say, Idaho Falls, Idaho, right? So any two cities in the US that they'd never even heard of, but in 10 minutes they could figure out. So dumbing down is not the appropriate word. We basically just made the whole process like a wizard, like, right? Just take 5 steps, and then you know, and it teaches you so much. So people loved it. All of a sudden, my meetup was full. Lots and lots of people were coming in from everywhere. I was starting to get conferences calling me from across the United States and saying, "Hey, you're that nerdy guy that basically teaches this thing called location magic that we watched on YouTube." Because by then, one of my YouTube videos had gone viral, and hundreds of thousands of people had watched it. And it was a long video, Dave, like 75 minutes, and we had like 80% of the people staying until the end, and hundreds of thousands of views. And so all of a sudden, I'm this micro celebrity in the data of real estate world, and everyone's asking me, what do you have to pitch? And I'm like, no, 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 I'm a technologist. I have a company. It's worth a lot of money. I'm not doing any real estate. I just buy my own stuff, and you're welcome to just take my stuff. And people are like, at least get a list together. So I started keeping a list of people, and that list grew from 100 people to 1,000 people to 10,000. And then one day a guy comes in from Apple and says, I'd like you to present across campuses. So he takes me into the Apple Spaceship campus, and all of a sudden I'm presenting to a very large number of people who are sitting in different campuses throughout the world and listening to me. One group was at 2 o'clock in the morning somewhere else in the outside the US, and they were still listening to me, and I could see them on the screen. And I'm like, this is cool stuff. How do I disseminate this? And so the idea I came up with is there's a website called Udemy, Udemy. So what I did was I took my data science course and I stuck it there at udemy.com/realfocus, or just udemy.com, Neal Bawa, it comes up. And I'm like, maybe 100 people will take the course. Well, right now, Dave, there's 12,500 people taking this course, and it has over 1,000 5-star reviews. It's the best reviewed course on Udemy in real estate, and they have 1,000 courses. And so I basically found a way to find my fellow geeks, nerds, and dorks and bring them together into this ecosystem of people that are basically just obsessively tied to data and using it to make investments. And I did all of that before I had a syndication, had ever taken money from an investor. I'm just a tech guy doing these things. And repeatedly, people are now, like 2012, 2013, I'm getting to the point where I'm selling my company, and people are calling me to conferences. I'm going to this conference, that conference, and I'm really excited because I'm getting all these free conference tickets, and people are even paying for my travel because they know that I don't have a pitch. I don't have anything to sell. And so in 2013, sold my business, immediately had a gigantic, massive tax bill. You can't imagine. It was just disgusting. And so at that point, I knew I had to get the depreciation benefits and jumped into multifamily value add. So I did value add first, then I did new construction, then I got into self storage, and did office, flex, student housing, townhomes, luxury townhomes, and then finally ended up with build to rent. And so all of these things have sort of worked out over time, and roughly 1,000 people have given me about $300 million of their money to buy stuff, to build stuff. It's all along, it's really been an experiment, and location magic has now developed into something that is, vastly more powerful than what it started with, but it still works and it still delivers amazing returns.
Yeah, fascinating story. And is that product available for the public right now? Can they take the class and actually access the software as well?
So yeah, the answer is everything's available for free. So we've never charged for it. There's no subscription, there's no upsell, there's no mentoring, there's no education. It's just given away. It's like Wikipedia. So take it, use it. The vast majority of people that have used it, maybe 100,000 people, I don't even know them because Udemy doesn't even give me their information, and I don't do the meetups in the San Francisco Bay Area anymore. So they're available in two places. One is multifamilyu.com. You can go there, you can take it, and then of course all of the pieces, software as you call it, are available right there. You just grab it and you come back once in a year. So it does require an annual update. So you come back every year in January, take the new course, or just skip through the course and grab the updated software. Or you can take it at udemy.com/real focus, and you'll notice there's about 12,500 people taking it. So it's free. It's meant to be free. We haven't even put a license on it, so technically, Dave, other people could even be selling Location Magic.
Yeah, that's interesting. And how does that compare to, some of the other analysts, whether it's Yardi or CoStar and things like that, from that data? How would you say it compares? Is it complementary? Is it providing different data points?
It's complementary in many ways. So I would always recommend that if you have the money, buy a CoStar license or buy a Yardi Matrix license. But I think that it looks at the world from a backtesting perspective, where Yardi Matrix and CoStar look at it from an incoming supply perspective. So it's highly complementary. I continue to use Yardi Matrix. I continue to use, CoStar data, but I still find Location Magic to work well. The one benefit of Location Magic over Yardi Matrix and CoStar is that while CoStar and Yardi Matrix provide phenomenal data for the top 50 or 100 metros in the US, they're extremely weak once the metro size falls below 500,000. Location Magic works for smaller metros, so I've been investing in smaller metros. For example, I invested in Idaho Falls, made 30 plus IRR for my investors. Idaho Falls is only 130, 50,000 people. There's no way CoStar would have data for that. So the Location Magic allows you to find smaller metros. Like my favorite metro in the United States right now is Rogers, Arkansas. Most people don't think of Arkansas as being an amazing metro, but I promise you this: if you take a flight and you go to Rogers, Arkansas, within an hour of you landing, you'll see exactly what I mean.
Interesting. And can you use this also not only for multifamily, but say people are doing short-term rentals or an Airbnb, or is that I'm assuming the data there is valuable for those type of assets as well, right?
It is, but I actually recommend that people not use that. The
Okay.
challenge with places like short-term rentals is that supply is a much bigger determinant of your success than anything else. So AirDNA is so inexpensive. I mean, it's $50. I mean, come on, right? Pay for AirDNA. It's a superior product. It's specifically designed for you. If you're doing short-term rentals and not paying for AirDNA, shame on you, right? Because CoStar is $65,000, so there's a bunch of people who simply can't afford it. But why wouldn't you be able to afford AirDNA at $40 or $100?
Yeah, sure. Okay, so before we jump into multifamily, Neal, I want to talk to you a little bit about your Mission 10K, which is pretty exciting.
Yeah, I am a mission-driven person, right? So luckily, because of my tech exit, yeah, I'm well off. I want to do things that I love. I want to do things that make me get out of bed every day and say, today is another fine day and we're going to change the world. So that's very, very interesting to me, because after you make more money, and I travel the world, I spent 2 months a year traveling Europe and Asia with my family. We have a blast. We spend our money. And so my life is now just tied to doing things that are fun and interesting and make a difference. And I know that value add multifamily, where you're improving older properties, makes a difference. I know that building newer apartment complexes makes a difference. But I was always looking for what makes the most difference. Once again, my data science hat is always on, right? So it's like, I don't want to make a difference. What makes the most difference to Americans? And what I figured out is while Americans will live in my Class A properties and my Class B and Class C properties just fine, most of the time they're living there because they have no choice, right? And I wanted to give them that choice. Well, most Americans want to own their own home, but since COVID, the average salary needed to buy a home in America has gone up 88%. You now need 88% to make 88% more in the last 3 years to buy a starter home than you did before COVID started. And that's a combination of, high interest rates and ridiculously higher prices, right? So prices have gone up. Single family prices went up, unlike multifamily, which came back down. They have not come back down. They're still at the peak. They've only come down about 1%, right? And that's seasonal. So home prices are still at peak. They're holding at peak. They're not increasing anymore. And interest rates as of today are at 7.18%, which means that you need an 88% higher salary to buy a starter home. So we have this unusual situation that was developing before COVID, but has now exploded after COVID. That situation is simply this. We've got families in America, right, with kids and dogs and those kinds of things. And that there's a band of these people that make good money, and I define good money as $60,000 to $80,000 a year for the family, that do not want to live in apartments and cannot afford to buy a single family home. I believe that I realized that and they also didn't want to buy the rent in really, really old single family homes, very trashy, but that's their other choice and they hate it. So I realized that this middle America, and I call it about 8 million families. My data indicates there's 8 million families that don't want to live in apartments and cannot afford to buy single family homes. I have decided that my mission in life, and I call this Mission 10K, is to build 10,000 brand new townhomes for these people. And these townhomes, they don't look like my Class A properties. There's no infinity pools, there's no CrossFit gyms, there's no clubhouses. It's not like a sexy apartment market that's a class A that everyone's building today. They're just a bunch of townhomes together in a community. There is no pool. There is no gym. But the question is, Dave, if your other option was to rent a 70-year-old trashed property, it's unlikely to have a pool and it's never going to have a gym. If people are simply looking for a place that's as close to owning a property as possible, brand new townhome rentals, 3 bedroom, 2.5 bath, 9 foot ceilings, quartz or granite countertops, no amenities, except, I generally have a large central area where kids can enjoy themselves. So there's a central park and there's a little dog area and maybe a swing and a fire pit, simple amenities, right? In the end, it's like a subdivision of single family homes, but they're townhomes. And I'm building these in many markets across the United States that you've never heard of. Why? Why am I not building them in superstar boomtown markets? Why am I not building them in, Orlando or Miami or Denver? The math doesn't work. I'm just a robot with some human qualities, right? I'm just tied to mathematics. I look at these amazing markets and I realize construction costs are too high, property taxes are too high, impound fees and permit fees are too high, insurance is too high. The combination of these four things kills my ability to deliver rents to that middle class America because they only make $60,000 to $80,000 a year. So my rents can't be more than $20,000 to $26,000 a year, which is essentially I'm trying to keep my rents below $2,000 a month and give them a brand new beautiful townhome property, right? Gorgeous 9 foot ceilings. How do I do that, right? Well, I can't. In most of these superstar markets, they're going to be what is known as rent burdened, which means that 45% of their gross income is going to go towards rent. That doesn't help America. And because I'm mission driven, I want to make profit for my investors. I've made a huge amount of money for them and I want to keep making money for them. But I wanted to somehow find a way to tie profit to not rent burdening people. So I went across the United States doing surveys of construction costs, permit costs, land costs, property taxes, and insurance, and found a bunch of metros that nobody knows about. And I am building townhome communities, 100 to 150 units at a time, non-amenitized in those areas, and I call it Mission 10K. My investors love it and have already given me $50 million that I have in a bank and that I'm now basically buying land at extraordinarily cheap prices. Because of increase in interest rates, land just has become practically worthless. So I'm paying like a third of what I was paying 2 years ago.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com. Yeah, I really love that, Neal. It's similar to how Peter Diamandis talks about an MTP, or your massive transformational purpose. So
Yes.
that is so spot on, and just really spoken like a true entrepreneur, right? Waking up every day, having something that you're fascinated and motivated about, and really making a difference, right, in the world, solving a problem for that niche market that you've identified. So really, hats off to you for creating that opportunity for those in need and solving that problem. I think it's really amazing, and have been interested and following to see how the progression goes. As we kind of delve into this, let's talk a little bit about the market. I know you're quite the scientist as well in terms of the market. There's been so many things going on, such interesting times that we live in, and dynamics. I'm not asking you to pull out your crystal ball, but give us some of your thoughts on where do you think the economy is right now with respect to pending recession potentially, and the other dynamics that you see.
Yeah, it's a incredibly interesting economy. The first thing that I do in the morning is I'll read everything that I can find on economics on in the Wall Street Journal, then Bloomberg, right? That takes me an hour in the morning. And because I find that as real estate, general partners, nothing is affecting our ability to deliver profits more than the general economy. The general economy right now is in charge of our ability to deliver profits to our investors. And so clearly understanding what's happening in the economy requires a tremendous amount of study. And I'm putting in an hour every day, including Saturday and Sunday, into that. And I've been doing that for the last 3 or 4 years. And that allows me to stay slightly ahead, just slightly ahead of the marketplace. So here's a few things that I'll say. Number one, stop worrying about inflation. You should have been worried about inflation 2 years ago, 18 months ago, 12 months ago, 6 months ago. Today, if you're worried about inflation, you're simply not looking at the data. I am worried about disinflation and deflation. Inflation in the United States peaked in June 2022, so that's about 14 months ago, at 9.1%, right? So whether you're looking at core or PCE, it peaked right about that 9.1%. Today, it's below 3%. If you look at it for the last quarter, it's at 2%. Now, that doesn't mean that the Federal Reserve will cut rates immediately, because they want to see it stay there and even go below that 2% line. That's when they're convinced that they can get it back to that baseline of 2 or 2.5%. And so I'm not suggesting that the Fed is going to cut rates anytime soon, but what I'm pointing out is that if you look at the mentions of the word deflation or disinflation in the last 30 days, the mentions are up over 400%. And if you look at the mentions of the word inflation, they're ebbing away, because we've broken the back of inflation. There was one last piece that we really had to look at, and that was wage inflation. So inflation comes from rents, right? So real estate. It comes from wage inflation, and it comes from commodity inflation. Well, commodity inflation's been low for a while. Rents in the United States are flat. So each month when you see that decline in inflation, a lot of that is because rents are flat. And we're looking at a 12-month time frame. Rents weren't flat 12 months ago. So each month as we go forward, inflation falls because those rents are falling, or the rents are not increasing. They're not falling, but they're not increasing. They're not increasing. So of the three main components, rents are supporting us because they're staying flat. Commodities are supporting us because the cost of oil has gone from $120 to 80, and China is the Chinese economy is doing so poorly that international demand is reducing. Remember, it's very difficult to get inflation when demand is reducing, right? Supply, demand is what drives up inflation, right? There's right now a lot of supply. For the United States, for example, has 1.2 million excess cars. So the price of cars is dropping. Both EVs and regular gas cars are dropping and have been dropping for months and months, and now used cars are also dropping. So we're seeing demand destruction in the economy, which is exactly what the Fed wants. And that's bringing numbers down. And so the concern over the next few months is going to be, are we going to get too much deflation? And if we get too much deflation, can it drag us into a recession? So for a while, the chances of a recession were decreasing because the economy was doing well. Unemployment still at 3.5%. The job growth is reducing, right? So 3 or 4 months ago, we were producing 400,000 jobs a month or 425 a month. I just saw the ADP report yesterday, and you'll see the government report come out tomorrow, Friday, and they're both going to be around 177 jobs, 177,000. Well, 200,000 is equilibrium. If the economy produces less than that number of jobs, you're going to go into a recession. So the Fed at this point has to be convinced, and more and more of the Fed governors are coming out and saying this. Bostic, who's Raphael Bostic, just came out this morning and said, hey, I think we're done. I think we're done. We don't need to do this anymore. And I'm talking about a Fed governor making a public statement today saying, guys, we're done. If we overdo this, we're going to go into a recession. Look, we didn't increase unemployment, but jobs have reduced. So who cares about the fact that unemployment is still 3.5%, and core inflation is down to 2%, PCE is down to 4%. You're making progress. You're clearly hitting it hard. Just stay where you are. So my belief is this: we're done. We're not going to have any more hikes, but we're not going to decrease rate for a while. So let's just say, I'm going to say, we're in the beginning of September here. I'm going to say February or March of next year is the first time that the Federal Reserve actually starts to cut rates, and they're going to be cutting gently. Why? Because unemployment is very low, so they have no incentive to cut fast, right? If unemployment had gone from 3.5% when we started, Dave, to 5, then the cutting process would have been fast. Well, unemployment, we started at 3.5, and today we're at 3.5. So the incentive for the Fed to cut fast is just not there, right? So the Fed cuts maybe in Feb, but the boost to multifamily with that first cut, there's a lot of people that say, well, we really need to see substantial interest rate cuts for multifamily to benefit. That is just complete horseshit. I look at that and I say, you clearly don't understand how mortgage rates work. You clearly don't understand how spreads work. You don't understand how SOFR and LIBOR affect the economy, right? Because you're not looking at this from an economist perspective, and you have to, because the economists and the economy is really holding, multifamily back. And so I can tell you, in Feb or March, we're likely to get that first decrease. And even if it's a tiny decrease of a quarter point, the difference that it makes to the multifamily market will be enormous. I can explain that, but I'll stop here.
Yeah, no, so many great points there, Neal. Really appreciate you giving that breakdown, because I think most people just get really, it's kind of like, paralysis by analysis, right? There's just so many moving parts in this whole thing and everything. So how do you make decisions, right? As an investor, and so we have a lot of investors on the show. They're trying to say, is this the right time to invest in multifamily? We've certainly seen transaction volume is down 70% this year in multifamily.
That's right.
And we like to look at a lot of fundamentals. So, I mean, let's go into that for a second, right?
Yeah.
Talk to us about, your data points from a fundamental standpoint in the multifamily space.
2024 is going to be the best time to invest in multifamily since 2018. Okay, I don't want to say best ever, or those words don't mean anything. I like to compare years, right? So obviously, if you bought in 2020 and you got lucky because prices went up in 2021, that's fine. But that had nothing to do with fundamentals. And you're asking a fundamentals question. That simply had to do with the fact that we rained $2 trillion on our economy and everyone bought stuff, right? Nothing to do with fundamentals. So when we are looking at fundamentals economies, we cannot look at 2020, 2021, or 2022 or 2023, because all 4 of these years are whacked. One because of COVID, one because of the money that rained after COVID, one because interest rates started going up, and one because interest rates are really high, right? So when's the last fundamental year? It's 2019. So I'm going to look at 2019 and 18, and I'm going to make my decisions then, because we didn't have to deal with all this money crap, too much money, too little money, too many interest rates. And I'm looking at that and saying, what does 2024 look like? Well, it looks like a bargain. It looks like a bargain to me, and I'll explain why, right? 2 years ago, a lot of my contemporaries are buying properties every month. There isn't one that I'll mention, but he was a student at one of my boot camps in 2018. And literally, I think he bought 10 properties in that late 2021, mid 2022 period. Why? Because money was raining down on him, right? Now, time will tell whether those were good purchases or bad. But from what I'm seeing, I was the one basically going to podcasts and telling people don't buy. And people are like, "Are you buying, Neil?" And the answer is, I bought one and a half property in that mad time frame. The mad time frame to me was second half of 2021 to like June 2022. There was this crazy time frame where people are buying properties at three and a half cap and trying to justify those numbers with outrageous underwriting. During that time, I bought one and a half properties. One of those properties was mine, and I exited my partners, so that was good. The other property that I bought was a military-based property, and people don't buy properties at military bases because every time soldiers leave, you lose like 10-15% occupancy. The people don't like that. And the bet I made was that's painful and it's going to happen. And it did happen, by the way, because a bunch of people left for not for Ukraine, uh, but for to support NATO. And so I did lose occupancy there once. But I bet that pain was going to be less than the pain of overpaying because I bought that property, at five cap. So today, despite the fact that I lost occupancy and went into the 80s once when soldiers left for the Ukraine war, that property still, at this point, is cash flowing for me, despite the fact that it had the same floating rate loan that everybody else had. Why? Because I didn't pay that much. I paid 30% less than what people were paying for other comparable properties. So I can tell you that during that time frame, I wasn't drinking the Kool-Aid, only bought one and a half properties, just sort of paid my employees, didn't do anything. Today, I'm saying to you this the next 12 to 15 months, I'll call it the next 15 months because we're looking at Q4 of this year and then all of next year. Those 5 quarters are great times to buy multifamily. And my reasons are very simple. Number one, prices of multifamily are down between 20 and 25% as of today, as of September, 2023. Today I can get a 25% discount from peak. It's not really a 25% discount because those prices were outrageous, but it's at least a 12% discount. Why 12%? Why, well, the answer is prices were too high and now are too low. So where's the median? Well, the median is I'm looking at 2018 and 2019 when interest rates were normal. Well, at normal interest rates, cap rates were not as low and crazy as they were in 2021 or as crazy high as they are now. They were in the middle. So number one, when I buy a multifamily property today, I'm getting a 12.5% discount. My second reason is simply this. 70% of all multifamily new construction in the United States has stopped. This number was basically 80 or 90% back in 2008. And we saw what that did to rents because we just didn't build multifamily for 3 or 4 years. And as a result of that, we had above trend rent growth for a decade, not for 1 year, not for 2 years, one full decade. Multifamily had more than twice the rent growth that it did historically. Why? Not enough supply. Well, we are doing the same exact thing right now. 70% of new multifamily construction has either stopped or is highly delayed. Now, does that affect rents today? Not at all, because there's a huge amount of supply coming in. And that's my third reason to be buying, because there's supply coming in from the craziness 2 years ago. So there's a huge supply. It's pushing down rents. So I'm getting a bigger discount. So I'm not getting one discount, I'm getting two. My first discount is cap rates, right? Cap rates are high because interest rates are high. And my second discount is rents are artificially low. Rent growth in the United States has been zero. How can rent growth be zero when inflation is 4%? If you look at the 50-year history of inflation and rent growth's always higher than inflation. Right now, it's 4% lower than inflation. Why? The answer is straightforward. There's a lot of supply. And that supply is coming in with concessions, 1 month concession, 2 month concession. And that supply ends at the end of next year. So then you have a hole in 2025 and an even bigger hole in 2026 before we start to see some normalcy in 2027. So I want to buy something when rents are artificially low and prices are artificially low. And both of those things are likely to correct in 2025 or 2026. That is the perfect time to buy an asset. So this has nothing to do with multifamily. It just has to do with timing.
Yeah, being a savvy investor, I love how you put that like multi-tiered layer of a lens on that, right? To be able to see, hey, these are ways that you can capitalize on the opportunity at three levels, and even if you're wrong by one and two out of
I've
three
got
pan
others.
out,
Yep.
you're still way ahead. So this brings me to another point I'd like to ask you, Neal, because we have again a lot of listeners, as you know, investors out there. They might be newer, right, to investing in syndications, real estate, other types of syndications. And let's face it, I mean, over 90% of Americans have the majority of their wealth tied up into government sponsored plans,
Yep.
or home equity and everything. So talk to us a little bit, and give us some data points from your side, as to, why investing in, multifamily real estate, another syndication, your views on that as compared to, typical stocks, bonds, mutual funds.
It's all about numbers. It's all about math, right? I wouldn't invest a single dime of my money, and I'm invested in 26 syndications. I haven't been doing much investing in the last 2 years because I believe the market was expensive. But I've been doing syndication investing for a decade, giving money to every syndicator that's, an expert in some market that I felt was interesting, but I didn't have the time to go do stuff there myself. So number one, I believe in this because the math is good. If you look at the average annualized return of syndications, then compare that to the average annualized return of real estate, and then compare it to the average annualized return of the stock market, it's not even a contest. First, real estate over any 10-year time, and the metric is called NCREIF, NCREIF. So just Google NCREIF versus stock market, and you'll immediately see the gap between what the stock market produces over a 5 or 10 year time frame. Usually you want to look at 10 years. They're always good, right? Because you want to have a couple of recessions in there. And then what NCREIF produces. And then what does syndication produce above NCREIF? Because NCREIF is basically just a bunch of really rich REITs, or real estate investment trusts, that buy properties and sit on them. They don't improve these properties. They don't go out and rehab them. They just sit on them and they make money. Nothing against REITs. They're awesome. Please invest in them. But my point is, those people are not there to improve properties. They're there to simply buy, and then, as rents go up with inflation, and rents and inflation are very strongly correlated, they make money over time. And they're smart about when they sell. They never sell in a recession. They never sell in a hurry. So they always end up making money. Good for them. But then you've got the syndicators above that are taking older properties that are 1980s product or 90s product. Nobody's rehabbed them. The properties are trash. There's old carpeting. There's, laminate countertops. There's white appliances that nobody's bought for 20 years. And we take that and we improve it. And we don't spend a huge amount of money. We spend $7 or $8 or $9,000 to improve each unit. And so now we're getting that same benefit that the REITs are getting, which is that as rents, inflation, is there, rents go up, but we're also creating additional value. And that additional value means that the average return over 1,000 or 100,000 projects is significantly higher than general real estate. And that's the math. That's the math that compels me to continue doing this. There's one tier above that, and that tier is Mission 10K, where I am buying ultra cheap land, and I really mean ridiculously cheap land, and building townhomes from scratch. When I do my value add projects, and I love value add, so I'm not trashing it. I adore it. I usually increase the value of rents by $150 to $175 per apartment. When I'm going from raw dirt, I'm going straight from zero rent to $1,800. And there I'm producing 12 times the value.
Yeah. No, points well taken. And, one that you didn't mention, right, which started your journey, was also the tax efficiency, right? Tax efficiency, and also the income generation, right, which is what we're all looking for, regardless of where you are in your journey, right? People are looking for that, passive income, having alternative streams of income. So appreciate those sentiments, Neal. And I also wanted to ask you, we've talked in the past around other sectors as well, and just, what are your thoughts on energy in general in terms of, a sector to invest in? What are your thoughts there?
I'm also equally fascinated about energy. There hasn't been a Bloomberg or Wall Street Journal or Economist article in the last 5 years that I haven't read. I read a website called oil, what is it? Oilprice.com almost every weekend. Here's my belief. The renewable energy market is far more disruptive than people understand. It is going to disrupt energy demand in the United States in the 2030s in a way that is extremely radical. How and the oil companies know this. The oil majors understand that over a 10-year time frame they're going to be disrupted. So the amount of money that the oil majors and the oil miners are spending on new exploration is way down from 5 years, 10 years, and 20 years ago. But the world is still continuing to grow its oil needs. 10 years ago, we needed 95 million barrels per day of oil equivalent. Equivalent includes like natural gas and other things, right? Liquids like NGL. So today, that number, just so you know, is 103 million. So with all that renewable energy coming in, and China's producing an extraordinary amount of solar, like just a ridiculous amount of solar. They're now producing more solar in a quarter than we're putting in a year. With all of that happening and accelerating, and EVs and rooftop solar, the world has managed to increase its oil consumption from 95 million barrels equivalent a day today to 103 million barrels. And the reason for that is simply this. The world has an ever-growing middle class. China and India now want to drive fancy cars, and so do African nations. So now we've gone from basically 15% of the world being American-like consumers to 30% of the world being American-like consumers. And so it's actually, I'm thankful that it's only increased by from 95 million barrels a day to 103 million barrels a day. So what we are seeing is renewable energy making an incredible impact and allowing us to continue with these lifestyles. But at the same time, we need more oil. But the problem is, because there's disruption going on, there's less and less people funding major oil finds, especially in the 10-year, 20-year horizons. And oil's always been a 10-year, 20-year horizon. So my fundamental belief is this. I wouldn't invest in oil in 2035, but I know that we're going to have shortages of oil in the next 10 years because if we keep funding all of the money towards renewable energies, which I'm in support of, by the way, we're going to have a shortage of oil. And so as an investor, I want to take advantage of that. There are going to be sporadic shortages of oil. That the equilibrium price of oil is $80 a barrel, and that's the price that we are seeing currently. So if you look at the price, the European price versus South Texas price, it's about that number, and that's fine. So we're at equilibrium. The world's at equilibrium. But here's what happens: one refinery somewhere shuts down, and all of a sudden we're out of equilibrium, right? Oil is the most inflexible product known to mankind short of food. We need food every day. We can get by without oil for a few days. But 99% of them, if I told you, Dave, hey, it's 3 miles to your favorite haircut place, why don't you just drive 2.5 miles and then walk the remaining half mile? No one will agree to do it as an American consumer, which means that somewhere in Iraq or Iran or India, there's a consumer giving up on their oil because we didn't want to walk that last half mile because there's a shortage of oil, right? And so what we essentially do is basically the price of oil, when there's a shortage of oil by 1% in the world market, 1%, just a 1% shortage, the price of oil goes up 25%. If there's a shortage by 2%, the price of oil nearly doubles. It goes up to $150 a barrel. That's how inflexible it is. And no one is sitting and calculating how much oil we're going to need in the next 10 years and how much exploration we're doing. There is no central agency doing this. There's no one coordinating. The OPEC people hate the Americans because we're producing shale oil, right? The Americans don't share anything with the Russians because we hate them. And so there's no central coordination of how much oil should be dug out. There's just a feeling that people have of how much oil there should be. How does this scenario and the inflexibility of oil lead to a flat price over the next 10 years. The statistical chances of that happening are close to zero. Great time to invest in oil, even though I believe in the next 15 years we'll solve all of our energy problems. But right now, I'm looking at a 5-year horizon saying there is going to be shortages. How can there not be? No one is paying attention to increasing use of oil. Everyone's focused on renewable energy.
Yeah, really solid assessment, Neal, and I would definitely, concur. And I think, there's so many important lessons for investors out there, right? And really trying to understand markets, the fundamentals, what's really driving things, because you want to be investing, where the puck is going, and kind of looking at these key data points, as Neal pointed out. So that's kind of why we're bullish on the energy sector. We're bullish on real estate. So some really great points. Neal, it's been such a pleasure today. One question I did want to ask you as well
Sure.
is if you could give the audience just one piece of advice about how they could accelerate their own wealth trajectories, what would it be?
Stop talking about Warren Buffett's famous comment, which is, when others are fearful, be greedy, and when others are greedy, be fearful. It's probably the best known comment in all of investing. Actually start following it. Everyone that's saying, I wish I could go back to 2009, I can tell you when I was buying a home a month, I was shitting in my pants because everyone around, all I heard was horrible news about real estate. Horrible, horrible news. People thought that the homes that I was buying for $80,000 cash, which used to be 250,000, would drop to 30,000, and I would be an idiot to be buying them at $80,000. There's never a time when there's opportunity and good vibes at the same time. Real investors invest in times of distress, and that's how they make money. That's all it is. So just stop, saying this stuff in cocktail parties and actually start following it. Anyone that doesn't actually do what Warren Buffett is talking about is not an investor. You're just a speculator that likes to call yourself an investor. Jump over to the investor side. You'll make a lot more money and you'll sleep a lot better.
Perfect. Yeah, that is so spot on. Really appreciate that. It's been really so insightful having you on the show today, Neal. Really appreciate all these pearls of wisdom that you provided for the audience. If people would like to connect with you or Grow Capitus and learn more, what is the best place they can connect?
Luckily, I'm the only Neal Bawa on the web. So first way of connecting with me is simply Google NEALBAWA. There, and pretty much all the good stuff and the bad stuff is about me. The second way, which is more structured, is to go to multifamilyu.com, multifamilyu followed by u.com. We do 12 webinars a year, and we share all of our thoughts. We actually have a webinar coming up on oil, and our thoughts on oil as an opportunity, even though we've never invested in oil. And we just did a webinar that 2,600 people signed up for about the impact of artificial intelligence and how it'll change the world, how it'll radically change the world. And so about 20,000 people show up for these webinars. It's basically our new way of giving information away. So one webinar a month. So everyone's welcome to join. There's no subscription, there's no upsell, there's no educational fees. Come in, join our community. And during these webinars, we spend 60 seconds talking about our projects. So if those look interesting, you can jump in.
Awesome. Thanks so much, Neal, and thanks to the listeners for tuning in this week.
Thanks so much.